taking a look at the charts, big volatility yesterday with the Fed coming out and cutting interest rates a quarter basis points, which really wasn't all that surprising. But the fact that they're talking about interest rates not really falling much next year at all, which I think a lot of people were expecting rates to continue to fall and for inflation to continue to stay high or continue to go even higher, has got most people pretty nervous. I think that's why we saw a huge bout of selling. Not so much the quarter basis points, but the forward projection of inflation staying up or rising and the rates not falling too much. Now, I see things a lot differently. I think when you take a whole lot of things into perspective and you put all the data points together from all the different types of assets and currencies and businesses and things like that, I think it's going to be a very difficult year. I think rates will eventually fall. I think we'll see inflation drop dramatically, but there's going to be obviously, I think, a big recession, which I think will bleed into somewhat of a mini depression, which will reset pricing. Everybody stops buying stuff, businesses go under, prices of things fall. There's going to be a lot of pain, and that will reset the economy. That's generally what you need, is a lot of pain to reset things. But so what the Fed says, I got a feeling will be out of their control and things will get ugly. But the market definitely scared yesterday, and this goes to show how dangerous some of the old kind of investing strategies are. And I want to just touch on that with the SP500 and dividend stocks, because this is the same with the energy stocks, because energy stocks generally have big dividends. If we take a look at the SP500 and we look at it just in the last little bit here, really since the high to the sell-off yesterday, it was down about 3.75% over the past week or so. Obviously, a big drop with the Fed, huge selling, people jumping ship. So, I mean, that's a pretty big drop over the past week and a half. But the thing is, most investors they're always told, get dividend stocks, take their yield, have that passive income. But the thing is, almost all investors are in those same stocks. And when we see dividend stocks, which the SPYD is the dividend stocks, look how they've performed over the past more or less a month. If you're an investor going for dividends and cash flow, you were down 9%, total bloodbath for that strategy. And this is why the buy and hold and just moving into blue chips and dividend stocks are so dangerous, that when things get ugly, passive investors using these old strategies just get absolutely annihilated. If we go back to the SP500 and we just look at, let's go back to 2020. And this is, again, we talked about this way back over here when it was happening, that you don't want to be holding dividend stocks. The SP500, the index fell 34%. That is a big drop. But when you look at it compared to people who play the dividend sector, the dividend stocks, let's just go back to COVID and take a look what happened then. Poor investors who go with these so-called safe haven dividend stocks lost almost 50% of their account. And bonds also collapsed. They had a short-term spike, which we played for about a 19% gain, but then bonds collapsed over 20%, and we saw both of these assets go down. So this is like the whole point of what we do here with asset reinvesting. Our strategy is we don't diversify. We're going to go into another point here where we're going to see stocks and bonds fall again. Just like in 2022, it was a bloodbath for investors. The strategies that most people use, they don't realize dividend stocks are super dangerous. Who cares about a 3 or 6% yield? If you're going to have to suffer a 50% drawdown, it's garbage. And that's the dangers of all of that stuff. So the most conservative plays are down the most. And this is just the beginning. When things get ugly, they're going to crash way harder. And that's why retirees, with these supposedly, proven strategies of buy and hold and diversification, get absolutely annihilated because they're all doing the same thing. They're all in the same trades. When retirees start to panic, they all dump the same positions, which are all the high dividend and energy stocks. And we talked about how the energy sector was going to have a big pullback and correction. It has had a massive pullback, and this is part of the reason. This is very linked. They're high dividend stocks. Energy sector is down 14%, as we talked about many times before. If we go way back here, I think we're going to see XLE eventually come back down into this 50, 40 range, and it's going to be a huge haircut, a huge reset. And of course, there's a million pivot lows in here that some of them have already been breached, We got all of these little pivot lows layered in here that each time one is broken, there is going to be a new set of stops being run. And of course, it's just going to wipe through this whole level here of this kind of rising support trend line. It's just going to break and collapse with the overall market. And of course, these are high dividend paying stocks. As you can see, there's dividends paid out pretty much every month or two or every quarter. And these are going to be hit very, very hard. Anyways, let's take a look at what also happened in the markets yesterday. So the SP500 and the indexes this morning are having a little bit of a bounce. If we just quickly look at the futures, this is just a technical oversold bounce. Huge beating yesterday, and now it's just some bargain hunters stepping in. If we look at our short-term signal here on our 30-minute chart, whenever we get a short-term oversold level, we tend to see the market want to bounce and move up. We had an oversold panic level yesterday, so we're getting a little bit of bounce off the lows. But other than that, yesterday was a day of huge fear. We saw the VIX spike 74%. If we zoom out on the VIX, we're way up over these highs where the market's bottomed before. It is set to open quite a bit lower this morning. But overall, definitely a big wave of fear. When we look at our panic selling indicator, this green indicator here, when it's over 3, which is this blue line, that is when we see short-term panic. When we have a close over 8, it usually signifies a very strong wave of panic selling, and it can actually become a standout low on the charts. Now, it might take 1 to 3 days to kind of shake itself out, but when I say a standout low, it can act like something like this here, where it's a very clear standout low and the market has a bounce. Like a standout low will be something like this. You get a big drop, lots of fear and panic, volume spikes, and then the market bounces. So it might take a little bit more to play out, but we should get some type of bounce and move back up. And we'll see how that unfolds. Again, this was a news-driven move. Anything that happens around news is usually given back. So if it's a big drop, we'll usually see at least half of it be recouped just with kind of a bounce. And we're starting to see that this morning in pre-market on the 10-minute chart. You can see the markets are starting to come up to recoup some of that. If we go and take a look, let's take a look over at the dollar. US dollar had a big move yesterday. So many people are bearish on the dollar, but really I'm most bullish on the dollar. It's actually my biggest position. All my investment capital is in US dollars. As I've mentioned many times before, I think we're going to see this continue to rip higher and move higher. If I was to take a look at Finviz, this is a thing that I think a lot of people haven't really realized. Actually, I'll show you that in just a second here. But overall, the dollar had a big move up. The way I've seen the markets move is when there is blood on the streets, when there is true panic and we are in a recession, we tend to see the US dollar do very well. 2008 crisis, the dollar screamed higher. The 3-year bear market and year 2000 tech bubble, the US dollar screamed higher. Everything pretty much, the dollar will go higher as all that unfolds. If we take a look at currencies and we look at the Finviz currency chart, let me just pull this up. As you can see here, the US dollar has been moving up. Every other currency has been moving down. And of course, if we look at Forex pairs, I'm in Canada, so I'm a huge fan of holding US dollars because the more US dollars I hold, the more value it's worth in Canadian dollars. The monthly chart, I did Fibonacci analysis on here, and it is telling us we're actually going to go to about $1.74 or something like that exchange. Like we're talking like probably some record highs. So there's huge potential to hold US dollars to gain like 20% from where we are alone. It has already had a huge move up over the years. I believe this is a launch pad, ready to just scream higher, and just holding dollars alone is a good play. And when the stock market crashes, this is when we see, like over here, we had the multi-year bear market, the tech bubble. The dollar rallied up fairly substantially. Actually, this is the Canadian dollar exchange, but we also saw it in 2008. Again, if we go back to the currencies itself and we look at the monthly chart, you can see the tech bubble, the dollar itself skyrocketed higher compared to other currencies. In 2008, percentage-wise, this may not look big, but percentage-wise, this was a huge move up as well. And then, of course, whenever we have economic weakness, we see big bouts, big moves to the upside. And of course, this is a natural trend. It's a pause, a rally, a pause, a rally, a pause. And I believe we're going to see the dollar index skyrocket higher as that defensive play. Of course, rising dollar is going to put pressure on precious metals. We saw gold have a big drop there yesterday. Gold was down about 2%. Silver was down a couple of percent as well. Silver is down another 4% this morning. So we're seeing it move dramatically lower. Of course, selling across the board has also hit miners. We've seen miners just fall out of bed and sell off here, much more percentage-wise than gold itself. And if we take a look at the bond charts, if rates aren't going down, then we're going to see bonds continue to move down. And we have watched bonds. We got out of bonds right up here. I think it was on this day here or this day. I think it was this day here with our CGS strategy. Bonds have fallen like 9%, whereas the stock market has gone the opposite direction. Actually, it shows it best over here. This was our both. We got long the SP500. We also got long the QQQ, which we locked in 10%, and we've closed out our QQQ trade. As you can see, assets, money was flowing into the indexes, which is where we moved, and we sold our TLT position, took all that money, moved into the stock market, and you can see how they moved in opposite directions. And if you were doing diversification, obviously you had stocks and bonds. Well, you've got one going up 10%, one going down 10%. It leaves you with like no return or a very tiny positive gain because you'll be a little heavier weighted in equities. But it just shows how they neutralize each other. There's no real strategy to that. It's throwing a bunch of darts at different things and hoping that a net gain will happen. But we're going to go into a time where I think we're going to see bonds continue to flatline or fall, and we're going to see the stock market crash huge, which is why you do not want to be holding multiple assets and being diversified, and you do not want to be holding dividend stocks. Pretty much everything everyone does with their long-term investment accounts, you don't want to do because it's going to turn into an absolute nightmare, I think, over the next 2 to 3 years and wipe out retirement accounts, retirement lifestyles, all of that stuff. All right, let's see what else we got here. Oil, if we go take a look at oil, it's actually holding up fairly well, trying to show that's got some resilience here. Again, the grand scheme thing for oil is it is bouncing bottom, trying to hold support. I think eventually we're going to see this break down. And when this does break down, energy stocks are going to crash in a huge way. Energy stocks have had already a 14% pullback, but when oil breaks support here, we're going to see probably oil drop very quickly to the $45 to $55 per barrel range. And then energy stocks are going to free fall even more. Again, if we look at energy stocks, they've been moving up. Meanwhile, oil's been going down. When oil breaks down and a recession and all that hits, we're going to see this thing just get absolutely pummeled and have a huge correction going forward. What else do we have here? Let's take a look over at the hot list. Actually, we'll go back to Bitcoin here. We did close out our Bitcoin trade 2-3 days ago now. We closed out, actually, I think I have it here with GBTC, which is what I traded it with. We ended up getting long here as we were starting to get that monthly chart breakout. We closed it out right near the high here for 40% gain. Now I think the markets could go into a pretty big reset. Overall, we hit our 100% measured move based on the Fibonacci level. So the low to the high to the low projected forward. This was a 100% measured move, and we wanted to get out there. And now the market's down about 8% from the high. And we'll see how that unfolds going forward. But that was just a quick explosive trade, which the monthly chart, I haven't traded Bitcoin for like a decade before this, but this was the monthly chart that really got me excited, which was we have this cup and handle formation, or you could just say this is a giant bull flag formation, and we started to break out through these highs. We got long and we played this pop, hitting that 100% measured move based on the most conservative pattern we had, so we could just hit it and get out. And so that was a really nice trade, and we'll see how that unfolds. Typically, when you hit 100% measured move, you're going to see some bigger volatility. Now, there is potential for Bitcoin to really scream higher. I do have a maximum upside target of about 160,000 per Bitcoin, but don't let a big number like that make you want to hold. It's that's not That's not how I work. It's not the best. It's not good to always pray for to reach the stars. It's better to take a bunch of good trades and take it step by step, wait for a fresh new setup, then get involved again. Let's take a look at NVIDIA, and I'll just flip back to the daily chart. So NVIDIA definitely has been underperforming. Typically, before it was wherever NVIDIA goes, the market goes. Well, the market has been going more or less higher for the last couple of weeks, and we've been seeing NVIDIA go lower. Not a very good sign. It has been lagging and underperforming. I think this is a very crowded play, and everybody I know is in it, and they're expecting to buy more on the pullback. More or less, I would argue we got a little bit of a kind of a topping, head and shoulders kind of pattern here. We kind of broke this pivot low. I think I was talking to somebody not that long ago saying, hey, if it breaks this low right here around this 128, this 130 area right here, this low, if it can pierce that, that actually might be a good trigger. Where this would be like the last straw where people put their stops. So if it breaks down below these lows and goes here, they're going to put a stop, which I think is what we saw yesterday or 2 days ago. Sorry, it flushed down, ran those stops. Usually where you'd put your stop is where you actually should be getting in. And that means all these people have been flushed out. And it had a really strong pop and move, but lots of volatility with the Fed there yesterday. So we'll see. I think it's overdone. I think it's run a lot of the stops out of the markets, and it might have a little bit of a bounce. But overall, the fact that NVIDIA has been going down, stock market's been going up, is not a good sign. It's definitely rotating and in a more or less a downtrend. If we look at our short-term strategy here, you can see it's gone from it gave a sell short signal, and it is underneath the key moving averages, continues to move lower. So it's not a very good sign. It's underneath the 50, the 20-day, the 5-day. All of them are sloping down as well. So this is a weak sign for the economy, I think, and the AI space, that it might be actually a little bit done for a while. Anyway, I think that's about it. NASDAQ yesterday took a pretty good haircut, pulling back. Obviously, it's a bit of a crowded play, very sensitive. The Magnificent Seven stocks all took a beating yesterday. That whole sector was down like 4.5% on its own, doing a lot of damage to the NASDAQ. And we'll see how that unfolds. It's still holding up above at the 20-day moving average. The trend is still up. It actually dipped into oversold territory. The NASDAQ at about, well, if we go to the QQQ, it'd be a little easier to throw price here, but overall it dipped into oversold territory around 524, so it's into an oversold territory. We'll see if it is set to open higher this morning and have that oversold bounce, but overall some damage was done. But again, we're just going to let this market work itself out. The trend hasn't changed. It's just a news driven move at this point, shaking things up. And the market this is what it does during a bull market. It tries to buck you off. Some of the sharpest and most of the sharpest 1 or 2 day pullbacks in the stock market happen in an uptrend. And then some of the strongest rallies, 1 and 2 day bounces in the stock market, typically happen in a bear market. So don't think this is not actually a bad sign at this point. This is just an overreaction, a news-driven move. People are super sensitive because the market climbs a wall of worry, and one little flash of something for them to think about and worry about quickly triggers a lot of selling. And we had huge panic selling, a big spike. Just like we had over here, a massive gap down, and then the market took off. So we'll see how things unfold and go from there. Talk soon. Bye-bye.